This is the lecture from chapter 21 of your book about accounting policies, changes in accounting estimates, and error correction. And whenever we're dealing with these things, the key is to make sure we maintain as much comparability as possible. So what we're trying to accomplish with this standard is knowing how to choose accounting policies, reporting changes in those policies, reporting changes in estimates, accounting estimates, and reporting the correction of errors. When we have a specific transaction or event, the first thing we need to do is to look to the IFRS, the standard that specifically deals with that situation. And it could be an IFRS, which are the newer standards, an IAS, which is an older standard, or interpretations that are developed by the organization. There may be appendices and implementation guidance that are included with these standards, but they're an integral part of the standards only if it specifically says that they are. So they don't necessarily have the same weight as if they are specifically mentioned as part of the standard. IFRS standards and interpretations are the very strongest source you can have when knowing how to deal with a specific situation. And when we apply them, the information is assumed to be relevant and representationally faithful. But what if there's no specific IFRS standard that applies? If there isn't one, then we just have to use our judgment. We have to develop a policy, an accounting policy that's going to result in what we believe is the most relevant and representationally faithful information. We want to base our judgment on hierarchies, on the hierarchy of what the strongest sources are. And so we can use other IFRS standards that might have similar situations. We have a conceptual framework in IFRS that we can refer to, and we can always use also use other sources if there's no conflict with them. For changes in accounting policies, let's first talk about what accounting policies are. They're specific principles, bases, conventions, rules, and practices that are applied by the company in preparing their financial statements. The most common source of a change in accounting policy is one that's required by a new or revised standard. An example is IFRS 16 about the new lease standard. And so when that's implemented, that represents a change in accounting policy. There can also be voluntary changes, and the intent of those is to create information that's more representationally faithful and relevant. And an example of that would be changing from the weighted average method of costing inventory to FIFO. If the change is due to different economic conditions or new events or conditions or things that were previously immaterial, that is not considered a change in accounting policy. Here is a diagram or a flowchart that shows us how to proceed when we have a change in accounting policy. And the first question asks, is the change in policy due to the initial application of an IFRS? If the answer is yes, then we have to ask, does the IFRS indicate a specific transitional accounting method? In some cases, there will be specific guidance about how to implement the new method. And when that's the case, we apply that specific transitional provision and move forward, and that's what we do. If there is no specific transitional method, then we apply the standard and use retroactive treatment, which means we go back and restate prior periods. If we do not have an initial application of an IFRS, it's a voluntary change, and in that case, we also have to do retrospective reporting. So just to talk about this in more detail, when we have an initial application of a new IFRS like IFRS 16, if the standard specifies transitional accounting methods, then we just follow them. If there isn't, we use retrospective application. Voluntary changes are accounted for using retrospective application. And what that means is we're going to apply the new policy as if it had always been applied, and we're going to change amounts in prior financial statements. When we present, in this case, we'd have to present 3 years. We'd have to go back to the earliest period that's presented and figure out what the balances would have been if we had been using the new method. We adjust the opening balance of retained earnings for the earliest period presented, and we also adjust opening balances of any other comparative amounts. And we always do that unless it's impracticable for us to be able to figure out what those changes are. The idea of it being impracticable is we're not able to determine what the adjustments are that are needed, even after putting in some significant effort. Those effects just may not be determinable. We may have to make assumptions about management's intentions in the prior period, or we just can't make estimates without knowing circumstances that existed in the prior period. An example, if we needed to estimate the fair value of a private company 3 years ago, we would need to know expectations that existed then and also know information about cash flows and so on. And it would be essentially impossible for us to do that. So if it's impracticable to apply the full retrospective treatment, then we're going to apply the change to assets, liabilities, and equity accounts at the beginning of the earliest possible period for which the effects are known. And if it's not practical to determine the cumulative effect on the current period, then we simply apply that new policy prospectively or going forward. With respect to disclosures, whenever we have these changes in accounting policy, we need to tell people about the nature of the change. We need to show the amounts of adjustments to all financial statements items, earnings per share in prior periods. And if the situation is judged to be impracticable so that we cannot apply the retrospective treatment, we have to explain why and explain what we did. When we apply a new or revised IFRS, we also need to give the name of that new IFRS and mention any transitional provisions that are applied and any likely future effects that we expect. Also, if there are IFRS standards that are coming out but not yet released or not yet effective, then we need to tell people what we're doing with regards to those new ones. Next, let's talk about changes in estimates. So a change in accounting estimate is an adjustment that we make to the carrying amount of an asset or liability or to the amount of the asset consumed in a period that results from its present status and the expected future obligations or benefits that are associated with it. The reason we have changes in estimates is because we get new information about things as time goes along. If we're uncertain whether the thing we're dealing with is a change in accounting policy or a change in accounting estimate, then we're always going to choose it being a change in accounting estimate. And so that's one example of that, at least in US GAAP, is when you change from one depreciation method to another. You might want to argue that that's a change in accounting method, but the way it's handled in US GAAP is we treat it as a change in accounting estimate, and the same is true under IFRS. You need to understand that estimates are simply part of what we have to do to apply accrual accounting. If we want to apply accrual basis accounting, we have to make estimates because nobody knows the future. So it's just part of what we do. We expect there to be changes. When we make an estimate, we expect we're going to get new information that's going to help us more accurately estimate it going forward. And so that's just part of what we do. Because of that, we're going to account for these things prospectively. We don't go back, but only forward. And so prospective application means we recognize changes in the current period and in future periods. Finally, let's talk about the correction of errors. When we have an error that was made in a prior period, it could be an omission or a misstatement, then we have to do something about that. We have to ask, was the information available when the financial statements were authorized? And could it have reasonably expected that that information could have been used in preparing those financial statements? Examples of the kinds of errors that we have to fix are arithmetic mistakes, mistakes in applying accounting policies, oversights, misrepresentation of facts, and fraud. So they can either be unintentional or intentional. When we have the correction for an error, we have to go back and restate the statements as if the error had never been made. In some cases, it may be impracticable to do that, but we do the best we can, even if it's doing a partial retrospective application or even prospective treatment. And so that's all there is with regards to changes in accounting policies, changes in accounting estimates, and correction of errors. That is the end of this lecture.